This building carries a certified 140 mile per hour wind rating, engineer stamped drawings, a permanent concrete foundation. It will outlast most of the stick-framed houses on its road, and the bank will not give it a mortgage. The shell starts at $6,900, a 480 square foot steel arch kit, not the finished home. Add the slab, the insulation, the interior, and the real number multiplies several times over. Here is the strange part. The bank's answer is the same at every price. Instead of a mortgage, the loan officer reaches for a different folder, the one that finances a riding lawnmower. Same paperwork, unsecured, short term. The reason is not the steel. It is not your credit. It is one sheet of paper produced in an office you will never visit, and once you see it, the refusal makes a strange kind of sense. Start with what shows up on the truck, because the refusal makes no sense until you have seen what is being refused. 1 or 2 pallets, corrugated steel arch panels, a single type of nut and bolt, an assembly manual, and a set of state-stamped engineered blueprints. That is the delivery. The structure those parts build is genuinely simple and genuinely strong. Each arch is self-supporting. The corrugated panel is both the structure and the exterior at once. There is no frame underneath and no interior columns. Load does not travel through beams and posts looking for a weak joint. It runs continuously down the curve of the steel and straight into the foundation perimeter. The roof and the walls are the same unbroken piece of metal. The pricing is ordinary. Kits run roughly $6 to $20 per square foot, and $6,900 lands a 20 by 24 shell, about 480 square feet, right around $14 a foot, mid-band. Not a clearance fluke. Now the sentence this channel says out loud every time. The kit is the arch, and the arch is not the building. A slab, closed cell spray foam, end walls, electrical, plumbing, and an interior turn, that's $6,900 into several times $6,900 before anyone lives there. But here is what the finished building is. Certified wind ratings around 140 miles per hour. Snow loads of 30 to 70 pounds per square foot. A permanent poured foundation. And a design that has been standing on bare ground around the world for 8 decades. Every single thing about that building says house. One institution disagrees. Walk into it with the stamped drawings and watch what happens. You bring the folder. Stamped engineering, the county building permit, a clean, itemized cost breakdown. You sit down and you say the word mortgage. Understand what that word actually asks for. A mortgage is a loan secured by the property itself. The house is the collateral. That single fact is why the rate is low and the clock runs 30 years. If you stop paying, the bank takes an asset it can resell. The building backs the loan. Now watch the conversation change temperature. Most conventional lenders decline the property type outright. Some banks carry explicit internal rules against metal frame structures and will not touch them at all. And the appraisal side delivers the quiet insult. Appraisers frequently classify steel arch buildings as agricultural or temporary structures. That is the paperwork bin for hay barns, storage buildings, and equipment shelters, not homes. So the loan officer, often genuinely trying to help, slides the conversation sideways. If the mortgage is off the table, how about a personal loan? Unsecured, shorter term, nothing backing it but your signature. That is the moment to notice something. It is the exact same product the customer 2 chairs down is using to finance a zero-turn mower. Same folder, same unsecured structure, same short clock. The bank has quietly moved your permanent home into the same lending category as lawn equipment. And nothing about the building changed between the parking lot and the desk. The steel is identical, the wind rating is identical, the foundation is identical. Only the paperwork category changed. So, the real question is simple and expensive. What does that lawnmower loan actually cost you? Put both loans on the table, side by side. Two loans, same borrower, same building. Watch the gap open. The mortgage that does not happen, a 30-year fixed rate, is averaging roughly 6.5 to 6.6% this month. At that rate, you pay about $640 a month in principal and interest for every $100,000 you borrow, stretched across 3 decades. The loan that does happen. Personal loans are averaging 12.28% right now for a borrower with solid credit. Go to the online marketplaces and 3-year loans average near 13.9%, 5-year loans near 17.8%. Good but not excellent credit gets quoted around 19. Federal credit unions are capped by law at 18, and the open market runs all the way to 36. But the rate is not even the real damage. The clock is. A mortgage amortizes over 30 years. A personal loan runs 2 to 7. That compression is where the pain actually lives. Run one example, and it lands. Say you need to finance $50,000 of your build. On mortgage terms, at today's rates, that is a little over $300 a month. On a 5-year personal loan at prevailing rates, the same $50,000 cost you roughly $1,250 a month. Same building, same $50,000, 4 times the monthly payment. That is what the lawnmower loan costs. The bank did not merely double your interest rate, it took a 30-year obligation and crushed it into 5. Which brings us to the only question that actually matters here. If this building is engineered, permitted, permanent, and rated to survive a hurricane, why is the answer no? The answer is not what almost anyone assumes. And it starts with understanding what a mortgage really is. A mortgage is not money the bank hands you out of a vault. It is a product the bank manufactures and then sells. Here is the pipeline. The bank originates the loan, underwrites it, orders an appraisal, and then, in most cases, packages that mortgage and sells it onward into the secondary market. Your loan does not usually stay with the bank that wrote it, which means the bank is not really asking whether your house is good. It is asking whether the mortgage it builds against your house will meet the standardized specifications that let it be resold. A non-standard mortgage is one the bank might be stuck holding forever, and banks do not like holding things. Now the part that changes the whole story. Fannie Mae and Freddie Mac, the two institutions that effectively write the specifications for that secondary market, technically allow conventional loans on non-traditional homes, including steel and post-frame structures like these. The rule book does not ban your arch. Sit with that. The refusal you got at the desk is not written in national policy. Policy permits it. The no is being generated somewhere between your application and the approval that never comes. Some of that friction is honest. If you plan to act as your own general contractor, many lenders add scrutiny or decline outright. An unfamiliar structure makes an underwriter slow, cautious, and eager to pass. The machine does not hate your house. The machine hates surprises. The machine wants predictability, not quality. And the exact place where your loan stops being predictable, the place it actually dies, is a single document. Before we open it, look at the routes that survive it. People do finance these buildings, just not through the front door with the word mortgage on their lips. Here are the routes that actually work. Route 1 is the standard workaround. A construction to permanent loan from a local bank, a credit union, or a farm credit lender. Expect to put down 20% or more, bring a detailed itemized cost breakdown, and convert to a long-term loan when the build is finished. And go local. Regional lenders and credit unions who already understand rural property and non-traditional builds are consistently easier to work with than a national bank that has never seen an arch. Route 2 is the arch's own quiet superpower, phased cash. This building bolts together in stages. Shell this year, slab and spray foam next year. Interior as the money arrives. Most arch buyers already assemble their own buildings because the structure was designed for exactly that cadence. No loan, no interest, no appraiser in the picture at all. Route 3 is the lawnmower loan used deliberately. On a small enough principal, a short, ugly personal loan on a cheap building can still cost less than 30 years of interest on an expensive one. The trick is doing that math on purpose, with the calculator out, instead of stumbling into it. Route 4 is private paper, seller financing or a land contract, with terms you negotiate directly, and a government loan nuance worth knowing. VA and similar programs can work if the home sits on a permanent foundation, is deeded as real property, and meets minimum property requirements. And most lenders add an overlay requiring at least 400 square feet of living space. Even the small 480 square foot build clears that bar by 80 feet. Every one of those routes runs into the same document. Time to open it. It is called an appraisal, and here is the thing nobody tells you. It does not measure your house, it measures your neighbors. An appraiser assigns value by finding recent sales of similar homes nearby. The working standard is roughly 3 comparable sales within a few miles sold within the last 6 months. That is the raw material. Without it, the appraiser has nothing to build a number from. Now the first failure mode. If the appraiser cannot find anything to compare your home to, they cannot assign a value and issue a report, and the lender can deny the loan on that basis alone. Not your income, not your credit. Your credit score never even enters the room. The loan dies because 3 houses like yours did not sell down the road recently enough. The second failure mode is quieter and just as expensive. The appraisal comes back far below what the home cost to build because the only distant comparables drag the number down, and now you owe tens of thousands of dollars in cash at closing to bridge the gap between the appraisal and the price. Underneath all of it is one blunt piece of logic. The lender needs assurance. The home is sellable on the open market if it ever goes into foreclosure. The bank is not valuing your house to see what you have. It is pricing its own exit from your house. And here is the trap closing on itself. Banks hesitate because few arch homes exist nearby to serve as comparables, and few arch homes exist nearby in part because banks hesitate. The refusal manufactures its own evidence year after year, a loop that keeps proving itself right. There is a practical counter. Before you apply anywhere, have a local real estate agent pull every arch home, barn-dominium, and non-traditional sale within 25 miles. The industry's own financing guides say it directly. Solve the comp problem first, and you have won half the battle. That explains the no. Here is what the no does to you later, because it does not stop at closing. Everything I just described happens again the day you sell. Your future buyer walks into the same bank, orders the same appraisal, and gets handed the same lawnmower loan. The financing wall you climbed on the way in becomes a buyer pool wall on the way out. Every barrier that made it hard to build makes it hard to sell. The pool of people who can pay for it shrinks to those with cash or a lender willing to fight the same battle you did. Price that reality into your decision now, instead of discovering it later. The lowball risk survives even a yes. An appraisal that lands below build cost does not just threaten approval, it means the shortfall comes out of your pocket at the closing table. That is a documented outcome, not a worst-case story. Now the fair part, because this channel does not stack the deck, none of this is a curse unique to the arch. Barndominiums hit it. Container homes hit it. Log cabins hit it. Every non-traditional structure in America meets the same machine at the same desk. The steel arch just happens to be the cheapest thing the machine refuses to treat as a home. And the cash route has its own cost, paid in patience rather than dollars. Phased building means living beside an unfinished project, sometimes for a year, sometimes longer. That is real, and anyone selling you the dream leaves it out. But here is the counterweight, and it is arithmetic, not optimism. The entire finished building can cost less than the down payment on a conventional house. When the number is that small, the machine simply matters less. You are not begging a bank for a fortune. You are funding something you could nearly cover another way. So put the whole strange situation on one page. The bank treats this home like a lawnmower. Here is the twist the whole video has been walking toward. At these prices, you can afford to buy it like one. Everything about the building is real. Engineered arches, certified to survive a 140 mile an hour wind, bolted to a permanent foundation, permitted by the county. And the refusal is real too. But it was never about the steel, and it was never about you. It is a comparable spreadsheet protecting a resale pipeline, a machine pricing its own exit, not your home. That machine was built for houses that cost hundreds of thousands of dollars. This one lives underneath its radar. Small enough to build in phases, small enough to cash flow out of a paycheck, small enough that even the short, ugly lawnmower loan is survivable because there is not much principal to punish you with. The limits stand where I left them. The wall comes back when you sell. Appraisals can land low and cost you cash at the table. Patience is a real line item. None of that disappears because I said something reassuring. But here is the verdict, and I want the wording exact. This is the rare purchase where being ignored by the bank is a genuine inconvenience on the way in, and almost irrelevant if you planned for it from the start. The lawnmower treatment is an insult to the building. It does not have to be an obstacle to the builder. 2 answers in the comments, and be specific. First, would you build this without a mortgage at all? Phased cash, a credit union construction loan, or the personal loan with your eyes fully open? Which one is you? Second, which surprised you more, the real reason for the no or the monthly price of the workaround? I read every comment, and I answer build questions personally. We cover alternative builds every week here. Real costs, real timelines, what works and what does not. Subscribe, hit the notification bell, and I will see you on the next build.